Another very important assumption in standard version of CAPM is the assumption that all the assets are fully marketable. However, that may not be the case. For example, human resources, real estate, cattle, and these kind of assets are not necessarily marketable. And even if some of they are marketable, like real estate, land, and house, it may take a lot of time, and due to taxes and frictions, you may not like to sell them as immediately as you would for a marketable asset. So in this video, we'll see the implication of removing this assumption or relaxing this assumption and taking that non-marketable assets also form a considerable size of or proportion of your portfolio. To begin with, CAPM assumes that all the assets are readily marketable. The implication is that an investor can freely and quickly adjust her portfolio to the optimum by selling or buying these marketable assets. However, this is not necessarily the case even with marketable assets such as investment into prohibited or regulatory stocks such as tobacco stocks. So some may not want to buy or sell those kind of stocks. Also, there are many securities that are not exactly marketable. Take, for example, as a human being, one cannot securitize the future claims to cash flow, such as my pension or employee welfare claims. I cannot securitize them and sell them in market as freely as I can to a security like equity. So, in a real economy, these non-marketable assets form a substantial portion of your overall ownership or your overall portfolio of wealth. Also, you can consider this non-marketability as a sort of additional risk which was not there in the marketable assets. To begin the analysis, let's say we can divide the world into non-marketable and marketable assets, and mathematics, ignoring the mathematics, the resulting model that has been arrived appears like this. There are few new terms that we need to explain. First is RH, which is the return on non-marketable assets. PH, which is the total value of non-marketable assets. PM, which is the value of marketable assets. Please remember, while we are defining these terms RH, PH, and PM, the assumption is that they are for a particular given period. So CAPM works period by period basis. So CAPM is a period-wise period equilibrium model. Let us contrast this new model with the original model. Notice that first, the price of risk which was given by this term has also changed, and the risk magnitude has also changed. We'll deal them one by one, each of these terms, the price of risk, which is risk return trade-off given by this expression, as well as the quantum of risk given by this expression. They have changed as compared to the original CAPM model. Let's see how it works. Let's look at this risk return trade-off, or what we call as price of risk. Earlier with standard CAPM, it appears like this, and with the introduction of marketable assets PH, it appears like this. It seems that there is some addition in the denominator. Now, in general, you would like to believe that there is a substantial portion that is PH in an economy, and therefore this PH upon PM is some finite number, may not be zero. For example, you have human capital, you have real estate, you have cattle, and so on and so forth, that you would believe that this PH upon PM is some finite positive number. That is one. Second, RH is the aggregate return, period return on non-marketable assets, and RM is the same period return on marketable assets. Generally, you tend to believe that when value of market assets, in general marketable assets, rises, non-marketable assets should also rise or fall with the marketable assets. For example, when the economy is booming, more jobs are created and worth of human capital is more. Similarly, real estate land also appreciates, and vice versa. When there is crisis, jobs are less, companies are shutting down, so value of human capital is less, and other non-marketable assets such as land, real estate, they also depreciate. And therefore, you tend to believe that this covariance is some sort of positive finite number, which is also significant. And therefore, if you look at this term on overall basis, this would be a positive number. PH upon PM, positive finite number. Covariance is also a finite number. As we said, it is positive with all the reasons we discussed. And therefore, this term is this risk return trade-off or price of risk is lower than the earlier assumed by standard version of CAPM. Now, if we were to believe that this covariance is, let's say, close to zero in a theoretical case, or PH is zero compared to PM, it's very close to zero, then we would have ignored this and gone with the standard CAPM. But we can see here that this term is not necessarily zero, and there's a high probability it's a big finite number. Therefore, the risk return trade-off or the price of risk is much lower as compared to that assumed in the standard CAPM. So this is the first component. While comparing the total risk, the definition of risk has also changed with the addition of this term. So earlier we had the covariance of the asset, marketable asset with market. Now we have the covariance of marketable asset with aggregate of non-marketable asset along with the ratio of total non-marketable asset to marketable asset. While, as we discussed earlier, this is supposed to be a finite number, positive number, there we cannot be sure. For example, an individual asset, unlike the aggregate asset, the individual asset can be negatively or positively correlated. Let's take two cases one by one. If this correlation is negative, then given that the risk return trade-off was lower and this number is negative, the overall term would be lower and expected returns, equilibrium returns on the asset as predicted by this new CAPM would be lower than the standard CAPM in the case where this is negative. However, if this covariance is positive, then we cannot say that with surety. Then it will depend whether this increase in risk vis-a-vis the decrease in price of risk, whichever is dominating. For example, if this increase in risk is sufficient to compensate for the decrease in price of risk, then the expected returns may be higher. However, if this increase in risk is not as large as the decrease in price of risk as we saw earlier, then the expected return will be lower. So the equilibrium returns as predicted by the new CAPM can be higher and lower depending upon these conditions as we discussed here. So just to quickly conclude the inferences, if the asset has a negative covariance, with the non-marketable assets, then its equilibrium return will be lower. However, if the return is positively correlated with the return on non-marketable assets, then it will depend on the following, which dominates. For example, whether the increased risk of the asset dominates or the decreased price of the risk dominates, as we discussed. That will determine whether equilibrium returns are lower or higher as compared to the predicted by standard version of CAPM. Now let's discuss the implications for the real market behavior. As per this version of CAPM, with non-marketable assets, each individual will hold three sets of funds or assets. Let's discuss them one by one. First is a special mutual fund. What is this mutual fund? What are the properties? So for any marketable asset J, this mutual fund has equal and opposite correlation or covariance with this asset J, as this asset J will have with this individual investor's non-marketable assets. So let's say this individual investor's non-marketable assets have some correlation, some finite correlation or covariance with each of the marketable assets like J, K, and so on. The mutual fund will also have equal in magnitude but opposite correlation with each of the marketable assets in the market as compared with his non-marketable assets. So if J has some kind of rho 1, 2 and covariance rho sigma 1, 2 with his non-marketable asset H, maybe HP, the mutual fund, this mutual fund MF will also have equal and opposite minus rho 1, 2 or minus sigma 1, 2 covariance and correlation with this is marketable asset J. So this also means that this portfolio, this mutual fund has a different composition for each individual investor, which depends on his holding of non-marketable assets. This is very interesting, and this explains or provides us with the justification that different individuals do not necessarily hold 2, 3 or 1 market portfolios as predicted by some previous versions of CAPM. And their holdings depend on their ownership of non-marketable assets. Essentially, the construction of this portfolio, the intuition basically behind construction of this portfolio is to diversify the risk of non-marketability or the non-marketability of the non-marketable assets held by that investor. The second asset is a risk-free asset, which is easier to understand. The third asset or third fund is the difference between the market portfolio and aggregate of all the investments in the first mutual fund. So all the in that economy and market, all the aggregate investment in this mutual fund, obviously every investor has different composition with this mutual fund, but we aggregate this for all the investors and get the macro version of this mutual fund. Then market minus this mutual fund, which is a fixed portfolio, will be owned by all the other investors. And therefore we can say the second and third asset is same for all the investors. The only asset that differs for all the investors is this unique mutual fund, which depends on their non-marketable asset. So to conclude, In this video, we discuss the implication of introduction of non-marketable asset in the portfolio of individual investors. We noted that with the presence of non-marketable asset, the resulting CAPM model is very different in terms of its price of risk as well as overall risk. And depending upon the quantum of these non-marketable assets in the economy and their correlation with the marketable assets, the resulting expected return of CAPM from CAPM may differ for all the individual investors. Moreover, the resulting portfolios of all these investors will differ, and they will comprise of three portfolios essentially. The, Out of these three portfolios, the first portfolio is a unique mutual fund which has a composition which has a negative and equal in magnitude correlation or covariance with each of the marketable asset in economy, with that this marketable asset has with their individual investors non-marketable asset. So essentially this mutual fund or this portfolio security is with a name to diversify their non-marketable risk of their non-marketable asset as much as possible. The remaining two portfolios are same for all the investors. The second is the risk-free asset, and third is the aggregate of market portfolio, the market portfolio minus the aggregate of this mutual fund, this unique mutual fund for all the investors, aggregate of it, which is one big portfolio in the economy. So market minus this aggregate mutual fund is the third portfolio, which will remain same for all the investors. In the standard version of CAPM, we assume homogeneity of expectations. That is, all the investors define their investment and consumption period in a similar manner, and in that same period, they have identical expectations of return distributions. That is, their expected return, risk, and correlation across these security returns are same and identical. However, obviously that is not the case, and all investors have their different heterogeneous expectations. In this video, we'll see how different variants of CAPM incorporate this assumption about heterogeneous expectations in the CAPM model and how different sources of heterogeneity are incorporated. To begin with, a very important assumption in the standard version of CAPM is homogeneous expectations. This means that all the investors have same expectation of risk and expected return as well as correlation across securities for different combinations of security. The implication of this assumption is that all the investors are expected to arrive at the same efficient frontier, minimum variance frontier and efficient frontier, and therefore the same optimum market portfolio. However, if this assumption of homogeneity is not available, then for each individual, separately an equilibrium return equation is drawn given their expected returns variances and covariances across securities, factoring their individual utility functions, because for all individuals different utility functions are there, and these different utility functions drive or result in different expectations about risk, return, and correlation matrices. Now, if one were to aggregate all these individual expectations, return expectations, and return and risk return trade-offs and distributions, then it will become a complex weighted average of expected return. So if you combine or compile individual return expectations and distributions of return, then the resulting function will be some kind of complex weighted average mean of expected return, variances, and covariances across all the individual investor estimates. Now this is problematic because these complex weighings involve information about individual investor utility functions, because they are driven by individual utility functions, and therefore in turn it requires information about risk return trade-off, or what we call as marginal rate of substitution between return and risk, which is a function of wealth itself or prices. So ultimately what we are saying, we are trying to determine returns, expected returns, or prices from the marginal rate of substitution and expectations of return, which effectively is a function of utility and risk return trade-off, or rather wealth itself. So effectively we are saying that prices are required to determine the risk return trade-off, that in turn will determine the utility functions, and therefore further the minimum variance frontier and then equilibrium pricing model, which in turn will determine the prices. So it is difficult to, given that the kind of endogeneity here we face, it is difficult to determine this kind of model. Although some researchers do try to create testable models under heterogeneous expectations, by defining some kind of heterogeneity or the form of heterogeneity through using functions that are rather constant rather than a function of wealth, the utility functions that are function of wealth, but constant, using constant risk aversion functions, they derive equilibrium pricing models which are not function of wealth. One of the famous such model is from Goenitz, that assumes that each firm is a combination of certain economic activities, and if there is some kind of disagreement for these economic activities that represent the firm, this is the only and one of the major source of heterogeneous expectations. And under this assumption and condition, the model shows that minimum variance frontier is the same for all the individual investors, and there is a market portfolio that is efficient for each investor, which further results in a linear relationship between return and beta, which is similar to the original standard CAPM. To summarize this video, we relaxed the assumption of homogeneous expectations, and we noted that particularly this, because of this heterogeneity in expectations, it became extremely difficult to model the prices or return expectations, because they are themselves function of risk return trade-off, which is further a function of utility, individual utility functions, which are further derived from the individual wealth level, and therefore prices are getting determined by something which is itself getting determined by prices or wealth. However, there are certain simplifying assumptions are available, such as one we discussed, where the only source of heterogeneity is differences about set of economic activities, and if the only source of heterogeneity is these economic activities, then one can model the risk return trade-off, and the minimum variance frontier and efficient frontier remain the same, and one can still obtain the market portfolio and the resulting return beta relationship, which is still linear and very similar to the original CAPM, standard version of CAPM. Another significant assumption in standard CAPM is the price taking behavior. It assumes that all the investors are price takers and their trading action do not affect prices. However, as we know, there are various kinds of investors, class of investors that do affect prices. In this video, we'll try to understand the impact of this non-price taking behavior. In the derivation of standard CAPM, we assume that individual investors are simply price takers. However, the evidence suggests that there are large mutual funds, index funds, and pension funds that do affect prices through their trades. The idea is that this price effector, this large institutional investor, which is also a price effector and does recognize their ability to affect prices, optimizes their trading decisions to maximize their utility based on the change in prices or based on impact of their own trades. While this price effector evaluates the equilibrium prices or resulting prices from his or her own trading actions, theory suggests that these class of investors, and including all the other investors, they should hold market portfolio along with the riskless asset, and therefore we should be able to obtain a version of CAPM which is very similar to standard CAPM. These price effectors, with their knowledge of resources and resources, they acquire more information about securities, do all kind of analysis, and hold rather large amount of risky asset in their portfolios, and relatively less of riskless asset than the average investor. Therefore, this price effector increases their utility of the market portfolio, because they hold riskless asset along the market portfolio. We are able to get the simple form of CAPM, but however, there is a critical difference in the proportion of risky asset in the holdings, aggregate holdings or market portfolios, in the sense that these risky holdings are relatively high and the price of risk therefore is relatively lower, because the overall risk goes in denominator in the price of risk, and therefore the price of risk is lower, that is expected returns per unit of risk. This analysis also gives the reason for existence of large institutional traders, portfolio investors, and collusion or sort of creating cartel among investors, large investors coming together in benefiting. That is, these large investors, large institutional investors, they collude together and understand the impact of their trading actions and benefit from that by increasing their utility. To summarize this video, we saw how non-price taking behavior affect the composition of market portfolio and overall aggregate holdings. We noted that this large investor or price affector understands the impact of their trades and maximizes their utility by taking a larger position in risky assets than that predicted by standard CAPM, which results in a lower price of risk at aggregate level and therefore lower return expectations as compared to that predicted by standard CAPM. In the standard version of CAPM, we assumed the problem of utility maximization with respect to investment and consumption as a single period problem. We also said that all the investors define their period in a similar manner. However, this is not the case, and we know from experience of life that as individuals, we maximize our utility over multiple periods horizon. To begin with, CAPM assumes that all the investment and consumption decisions have a single period horizon. But we know that in reality, an investor holds a series of portfolios or makes his or her investment decisions over lifetime, or if not over multiple periods, based on multiple periods to maximize her or his utility. And the decision in a single period is not taken in isolation. It is dependent on other periods as well. So we try to answer the following question to simplify this multi-period problem: that are there any conditions over which the single period CAPM models can adequately describe multi-period decision making? In this backdrop, Pharma suggests the following assumptions can reduce the multi-period investment consumption decisions into the problem of maximizing a single period utility function. That is, these set of assumptions, they sort of make the investment consumption decision state independent. Let's look at these assumptions. First, investors act as if their tastes and preferences for consumption of various goods and services are independent of future events and conditions. Second, investors' active consumption opportunities of goods and their prices are known at the beginning and are not state dependent. Third, investors act as if distribution of security returns are known at the beginning of the period and they are not state dependent. So you can see all these assumptions are trying to make different aspects of decisions such as expected returns on security, consumption opportunities related to goods and services, and so on and so forth are state independent and known at the beginning. Now, in addition to these assumptions, if our good old assumptions pertaining to preferring more to less and risk aversion hold with respect to each period consumption, then one period utility function has the same properties as one period consumption, and this helps obtain one period utility function which can be used to define multi-period investment consumption decision making. So with these assumptions, single period CAPM models become appropriate for investors with multiple or multi-period horizons of investment and consumption problem and multi-period utility maximization. Similarly, if the additional assumptions are made as per the zero beta version of the CAPM, then the zero beta version model becomes the appropriate version for investors with multi-period horizon. To summarize, in this video we saw that we can optimize or adopt the single period utility maximization function to multi-period horizons or investors with multi-period horizons by making some simplifying assumptions related to consumption of goods, investment, and so on, and making them state independent. That is, they are state independent and known at the beginning. With these simplifying assumptions, the same single period CAPM, maybe standard version or zero beta version of CAPM, can be adopted and extended to multi-period version of CAPM. Previously, in the standard version of CAPM, we assume market as the only source of risk. But we know from our experience that there are other sources of risk to securities such as inflation risk, default risk, revenue risk, and so on. In this video, we'll see how these additional sources of risk can be incorporated to our standard version of CAPM and another alternative variant can be obtained. So in addition to market, we said there are a number of other risk sources that can be priced such as inflation, default, and so on. And these risks like beta, they will also affect the expected returns on securities. So incorporating for these risks, a more generalized model for multiple risk is obtained, which appears as follows. You can see it's very similar to CAPM, like RI bar, expected return on security I, minus RF equal to beta M, which is the sensitivity of the security to market, into RM bar minus RF. But then there are some other terms introduced, and the interpretation is fairly simple and aligned to the standard CAPM. For example, RI1 bar is the expected return on influence 1. RI2 bar is the expected return on the risk influence 2. These are the systematic risk influences that affects the return stock, like inflation or default risk. RI1 bar minus RF is the risk premia or the price of risk on this influence 1. So this reflects the risk premia additional incremental risk return for bearing 1 unit of risk associated with this factor 1. Similarly, RI2 bar minus RF is the incremental risk or price of risk for bearing 1 unit of risk associated with influence 2. Beta I1 and beta I2, these are sensitivities of the stock I corresponding to the portfolio that hedges away the inflation or the risk factor I1, and similarly for I2. What we are essentially saying is that if there is a portfolio that hedges away these systematic risk influences, let's say I1 is the inflation risk. So if there is a portfolio that hedges your inflation risk, then beta I1 is the sensitivity to this portfolio. So this generalized model that we saw here, it represents the expected return RI1 on set of risk factors IJs proxied by the portfolios that can be employed to hedge them, like the one we discussed, like inflation risk or default risk. And it provides the expected return expectations given all these factors, systematic influences. It incorporates the influence of these factors, different factors in addition to market. However, this model does not tell about these factors, and these factors have to be obtained from additional analysis such as maybe factor analysis or from theory and so on. So to summarize, we saw that in the standard version of CAPM, we can incorporate other risk influences or systematic risk influences to model the pricing or security price behavior and capture these additional influences. However, the model does not tell us what these factors are, and the factors should come from maybe theory or some statistical analysis like factor analysis or principal component analysis. The standard version of CAPM assumes investors investing in consumption problem as a single period consumption problem or single period utility maximization vis-a-vis investment and consumption. However, we know that indeed this is a multi-period consumption and investment problem. And in this video, we'll try to explore that how, when multi-period consumption is considered, how utility maximization problem can be simplified and incorporated in the standard CAPM. Now, this multi-period consumption version of CAPM aims to capture the fact that investors may optimize their consumption over time, not necessarily in the single period, but over multiple periods, that is now and in future. For this, we need discount factors. These discount factors are stochastic in nature and they represent the cost of delaying the consumption in some point of in future. So these discount factors try to capture that cost of delaying the consumption, sort of opportunity cost. In that sense, this model is similar to multi-period CAPM, that we are trying to optimize the utility for consumption for multiple periods. And this model helps provide a framework to value intertemporal financial claims across different periods. So the idea is that we observe security prices, and these security prices represent the present values of money or dollar that has grown over the years when invested in these securities. That growing dollar invested in these securities, when it is discounted by these stochastic discount factors, then we should observe the present values of dollar today and essentially the prices that we observe. So you have security prices that are observed, which capture the discounted values of dollar invested in these securities growing over a period as with the security price. So if we discount today with the help of these stochastic discount factor, we should be able to get the prices observed. And this, therefore, in this manner, these discount factors are observed from the security price behavior, that is observed and expected returns. We get these discount factors. In practice, you get the aggregate consumption figure with a lot of delay. So these are delayed indicators, and therefore what one can do is one can find those vector of factors that affect stock prices that capture the aggregate consumption. For example, industrial stocks, stocks from FMCG companies, which give us slightly leading and more advanced indicators of aggregate consumption. One can find those vector of factors through maybe factor analysis or principal component analysis that affect these stock prices. And once you have those vector of factors, maybe mathematical proxies of those factors that affect these stock prices, essentially we consider these vector of factors as affecting or related to aggregate consumption, and which help us predict the consumption and consumption growth slightly in a more timely and advanced basis. So we can use these vector of factors as a proxy of aggregate consumption and therefore make predictions about consumption in more timely manner. To summarize, in this video, we broadly gave an overview or sort of superficial understanding of what would happen to the standard version of CAPM when multi-period consumption problem is incorporated, which will include the role of stochastic discount factors on period basis on the consumption of individual. Essentially, these discount factors capture the opportunity cost of delaying consumption on period by period basis. However, mathematical description or mathematical modeling of this is slightly more involved and not part of this discussion, out of the scope from this discussion. While arriving at the standard version of CAPM, we assumed away a number of real life phenomena such as taxes and frictions, which may appear to be rather drastic, and therefore the reliability and robustness of a model like equilibrium model like standard version of CAPM is not in how drastic or radical the assumptions are, but its ability to describe the real market behavior, the prices and expected returns observed in real financial markets. In next series of videos, we'll try to test this claim and we'll see how to empirically test various versions of CAPM. To begin with, various tests of standard versions of CAPM or zero beta version of CAPM entail testing a model like this, where RI is expressed in terms of expectations, expected returns. RZ is the expected return on zero beta portfolios. Beta are the expected values of beta on the stock, and RM is the expected value of market return. So these are future expectations. There is no way you can measure future expectations. So the assumption in these models is of averages, that on average expectations materialize. So if your data is of sufficiently long period, the average inferences, the inferences based on averages of data would indicate expectations or capture the expected behavior. So this is one set of testing the models. Another set of models of standard CAPM or its versions, they work with realized returns. And for that, to make simplistic description of reality or equilibrium, they assume a linear relationship between market and security returns, so that security returns can be, the realized return can be expressed in terms of realized market return. So basically this assumption helps us in using some form of model or description where we are using realized return instead of expected returns. We assume only one risk inference, which is market, so we describe our security returns based on the beta of our stock to market portfolio through a market kind of model or single index or market model. We have already seen the index model, so it's like a single index model or market model, as we can see here. Now, application of this kind of model to describe reality hinges on the following three assumptions. First, this assumes that market model holds in every period, and because we'll be using RF in this model, so this model also assumes that CAPM holds in every period and that beta is stable over time. So this model, while using realized returns, assumes that market model is valid, CAPM also holds, and beta is stable over time. With these assumptions, one can employ this kind of model on realized returns. So when we start testing some form of CAPM, maybe simple standard CAPM or the two-factor zero beta version of equilibrium model, we, at the underlying theoretical underpinning, we have three aspects. One, that beta is an appropriate measure of systematic risk and higher beta should be associated with a higher level of returns. That is one fundamental assumption. And therefore, return should also be linearly related to beta. That means one unit increase in beta should lead to some kind of unit increase in returns. Third, systematic risk are the risks that matter to markets. So markets do not reward bearing non-market diversifiable risk. Only systematic risk like beta matters. Lastly, in addition, whatever form of general equilibrium model, it may be simple standard CAPM or zero beta two factor CAPM, whatever model of general equilibrium model or description of reality we assume that investing is fair game with respect to it. That means after accounting for this model, which we assume as true description of reality, there are no excess returns to be made. In mathematical term, this means that the error term from the model, the error that we extract from the model, the deviations are purely random. There is no systematic pattern in that error terms. If there was some systematic pattern, then even after accounting for that model, we could have made some extra money by analyzing those patterns in the error term. Lastly, once these common assumptions are taken care of, that is the presence of beta and as a systematic risk measure and its relationship with expected returns, the specific assumption pertaining to a given general equilibrium model, for example, be it standard CAPM or zero beta version, one can make certain specific hypotheses and certain specific assumptions to find the correct model. For example, if you're making the zero beta version, then instead of RF was with CAPM, instead of RF, you need to use RZ bar as expected return on zero beta portfolio, a portfolio which had, although it had some risk, but its market risk was zero, so it had no correlation with market. So some specific assumption to this zero beta would lead to a equilibrium model or testing of a model which is of this form. Or if you're making assumptions which are similar to standard CAPM, then you will get a model, or rather testing the model which is of standard CAPM form, and so on. To summarize, in this video, we saw how to test various versions of CAPM starting from standard simple CAPM and models like zero beta CAPM through realized returns. How to use realized return to test these models, the presence or the validity of these equilibrium models. We also discussed what are the assumptions behind testing these models. For example, we noted that beta is the appropriate measure of risk, and this beta is linearly related to the expected returns. So what are the assumptions that are behind using a given set of model of equilibrium prices? In this video, we'll discuss the seminal test of Sharpe and Cooper in testing the validity of standard CAPM and other versions of CAPM. In particular, we'll discuss how they've shown that expected returns are linearly related to beta, which is aligned to the prediction of general equilibrium models like standard CAPM. To begin with, testing of such models such as standard CAPM begins by estimating beta with an assumption or using model like single index or market model like this. So using this model, we estimate betas. In this model, if riskless rate RF is not available, then one can use RZ, zero beta portfolio. For example, in their seminal test, Sharpe and Cooper, they constructed 10 beta sorted portfolios by estimating betas for the previous 60 months. Their period was around 1930s to 1960s. And over this period, for each year, they found, or rather constructed, beta sorted stocks, or sorted the stocks across beta quantiles of beta, 10 deciles rather. So they started with a period of 1931 to 67, and they employed the regression model on the portfolios ranked according to their beta, the market model that we discussed earlier. They sorted the stocks into 10 stock portfolios sorted on based on beta and created equally weighted stock portfolios. So they sorted the stocks based on beta every year, based on previous 60 months data, estimating the beta, and these betas are basically sort of their forecasts of beta for the next coming period. So they held these beta sorted stocks for 1 year and computed the average returns from this equal weighted average portfolios. And this procedure was repeated for each of the subsequent years, computing beta for the previous 60 months, that is 5-year period, and then every year on year changing the composition based on the previous year 5-year beta estimates. So first, their average returns appeared like this, and their forecast betas based on the previous 5-year returns, computing beta based on that market model of Ri equal to Rf, or alpha, what we are calling as alpha into beta I times Rm minus Rf. Since this is, we can put here error, or if we put in terms of expectations using bar here, then error terms will be, expectation of error will be 0. So in either case, they computed beta based on previous 60 months, and using these forecast betas, they sorted the stocks into 10 deciles and computed average return from these equal weighted portfolio of stocks. So these are the average returns shown here. These are the average returns, and these are forecasted betas. First and foremost, they found a linear relationship, as we can clearly see, kind of linear relationship where returns decline with decline in beta. So there is indeed some connection between average returns and portfolio betas. So this is in agreement with the description of reality by general equilibrium models, which suggest that beta and returns should be related to each other. A higher beta should result in higher expected return, and expectations are sort of described by averages. Next, they plotted this relationship between beta value and average return, and they conducted a regression model, and they indeed found a relationship, a linear relationship of this sort between expected return and beta, which explained almost 95% variation in returns. That is, 95% variation in returns explained by the beta. So in a sense, this kind of test confirm the CAPM postulation that returns are positively and linearly related to beta. Also, they found intercept of 5.54%, which was higher than the prevailing risk-free rate of around 2%, which indicated some kind of zero beta version was more appropriate. To summarize, in this video, we examined the portfolio test of standard version of CAPM and zero beta version CAPM conducted by Sharpe and Cooper. They sorted portfolio in deciles based on their historical betas used as forecasted betas. They compared the returns with betas and found that beta is indeed linearly related to returns. They also examined the linear relationship, and this relationship was found to be similar to zero beta version of CAPM, where expected returns were linearly related with the risk, that is beta. In this video, we'll conclude our understanding of empirical tests of CAPM and zero beta version of CAPM with the most celebrated Farmer-Macbeth versions of first and second pass regressions. The more advanced test of CAPM included the following form of regressions. First, they conducted a time series regression called first pass regression, which was employed to estimate betas. The following form of regression, RIT equal to alpha I plus BIRMT into AIT, was employed in time series version, and through this regression, the BI, or rather beta I, was estimated. Once this beta I was estimated, which was sort of market risk or correlation of individual stocks with market, then the following cross-sectional model was employed. So this was the time series model, first pass regression, and in the second pass regression, the betas were obtained for each security, and for a cross section for all the securities, this kind of model was run. Here, SEI square is the variance of residual term EIT. So in a sense, it represents the idiosyncratic risk, while BI represents the market risk. So this kind of model was run in cross section, and here eta IT equal to residual term, and this was employed for a given time t for each time period separately. So that is why this is called cross sectional regression. Now, when this cross-sectional model was estimated, where SEI square is the variance of residual term EIT, theory indicates that this term alpha 1 or A1, if we were to believe in standard or zero beta version of CAPM, then it can be RF or RZ, which is corresponding to standard version or zero beta version. Similarly, A2 can be either RM minus RF or RM minus RZ. Bar represents the expected values. So RZ bar, RZ bar. Similarly, we expecting A3 to be 0. Why? Because we assume, as per the standard version or zero beta version of CAPM, that the idiosyncratic risk has no predictability, or markets do not reward for bearing idiosyncratic risk. So this idiosyncratic component or variance of residual term should have no relationship with the expected return. So broadly, the empirical evidence concurred with the zero beta version of model. That means this A3 was 0 and this A1 was higher than risk-free rate. It was somewhat higher and indicated that it is corresponding to some zero beta risk-free rate. And A2 was significant, which indicated that indeed the market risk or systematic non-diversifiable risk has some power or explanatory power over expected returns. Let us discuss the very celebrated first and second pass test of Pharma and Macbeth. In these tests, they formed 20 portfolios of securities and estimated betas of these portfolios through first pass regression. The reason is that often single security betas estimates are noisy and vitiate the estimation by mixing with other terms. So portfolio betas are very sharp and less noisy. Errors and noise is very less. So they started with this first pass model, the time series model, where for each portfolio I, betas or BIs were estimated for each security portfolio separately, conducting monthly time series regressions. And once BI was estimated for each of the portfolios, then cross-sectional regressions for each period was employed for a very long horizon. So for each of the month over this very long horizon, for each month, cross-sectional regressions were employed by using betas estimated from this first pass regression to estimate this kind of model. Here beta I is nothing but BI here. So let us discuss this model first. Here SEI is the variance of residual term EIT, which is sort of proxy for idiosyncratic risk, non-idiosyncratic diversifiable risk. Beta is again the systematic market risk, and beta I square is the non-linear version of that. Eta IT is the error of this model. Let's interpret the coefficients one by one. So through this cross-sectional model that we see here, a very important set of hypotheses are tested. A series of hypotheses regarding different versions of CAPM, that is standard CAPM or zero beta CAPM, are tested. First hypothesis, that we are hoping that this gamma 3t is equal to 0, that is residual risk or idiosyncratic risk does not affect the expected return RIT. Here we have written RIT in expectation form. This eta term will be 0 and RIT will become RI bar. So gamma 2t here is the coefficient of variance, non-linear term of beta I, and we assume in the standard version and zero beta version that there are no non-linearities in the model, that is the relationship between beta and returns are purely linear, and therefore we are hypothesizing this term to be 0. Lastly, we also assume that this gamma 1t is positive and significant. That means there is a statistically strong relationship or significant relationship between beta I, that is the market risk or systematic risk measure, with returns. So if that is true, or some kind of equilibrium model like standard CAPM or zero beta CAPM holds, then this gamma 1t is greater than 0 in a statistically significant manner. Now, in the previous set of hypotheses, only if 1 and 2, that is corresponding to gamma 2t and gamma 3t, are 0, then we can say with statistical significance that some version of standard CAPM or zero beta CAPM are valid, because these two corresponds to certain coefficients, if you recall, gamma 2 and gamma 3, which are not consistent with the postulation of standard or a zero beta version of CAPM. So they need to be 0. If they are 0, then one can proceed further to examine the expected values of gamma naught t and gamma 1t, that is coefficients gamma naught t and gamma 1t, and see whether standard version of CAPM or zero beta CAPM is a better description. For example, if gamma naught t, expected value of gamma naught t, corresponds to RF, then probably standard version of CAPM is a better description. But if it is higher than RF, then probably zero beta version. Similarly, if gamma 1t would be then either RM minus RF or RM minus RZ, depending upon applicability of standard version or zero beta version of CAPM. So we can examine all of these coefficients along with the residual term to see if market operates as a fair game. What do we mean by this? What we mean is that for any given period, whether standard CAPM or zero beta CAPM model holds, the prior values for any period, if you find for a given period the prior period values of gamma 2t and gamma 3t, it should not be possible for investor or any market participants given previous period values to predict the next t plus 1 period values of these terms. That means the expected values of gamma 2 and gamma 3 should be 0 for any period, irrespective of their values in the previous period. If they are not, then one would be able to make money and the market will not be fair game with respect to the equilibrium model estimated here. So whatever the actual realized values, exposed values of gamma 2t, gamma 3t we observe for any given period t, the next period expectation should be 0. So what we say that expected value of gamma 2t and expected value of gamma 3t should be equal to 0 regardless of their values in the previous periods. Now, if that holds true, that is gamma expected value of gamma 2t and gamma 3t are 0, then one proceeds to see whether standard version or 0 beta version kappa is the true depiction of reality. And there we test whether deviations of gamma naught from its mean and gamma 1 from its mean are purely random. For example, if we believe 0 beta version is a true depiction of reality, so the mean of gamma naught is expected value of rz or rz bar, and deviations, period by period deviations of gamma naught t from its mean should be 0. If we believe a standard version of kappa holds, then gamma naught is rf and its deviation from rf from period to period, their expected value or average should be 0. Similarly, if gamma 1t is Rm minus expectation of Rm minus expectation of Rz, the deviation should be purely random. If you believe in standard kappa, then instead of this expected value of Rz, you'll have Rf. And again, the deviations of gamma 1 from its period on period value should be 0. That means based on historical values of gamma 1t, one should not be able to predict future values of this gamma 1t. That is what we mean when we say market is fair game with respect to the equilibrium model. Also, in these models, beta is a very important component that was estimated from time series regressions of individual security portfolios. However, when you work out betas from individual securities, often the errors are very high and some of the beta related risk is loaded on error terms. The model is not very well estimated, and that is why it is always advised to, rather than estimating for individual securities, we should estimate betas for security or industry portfolios for which we are looking for. For whatever securities you are looking for, you can estimate for corresponding industry portfolios. Similar, Pharma Macbeth also employed 20 security portfolios to estimate beta. Otherwise, the error terms, the additional risk in beta, which is not well modeled, will be loaded in the error term, and there will be some kind of spurious relationship between residual and returns, which will appear in model and may lead us to spurious inferences. To summarize, in this video, we examined various advanced tests of standard and 0 beta kappa. Some of these specifications involved testing whether the relationship with the idiosyncratic variance or standard deviation of error term is 0 with returns, and also the non-linear relationship of beta with return has a 0 coefficient. Once only these coefficient, that is relationship of non-linear beta and idiosyncratic risk, are 0, then only we can say that some kind of standard kappa or 0 beta kappa holds. Once we establish that, then we proceed further to check whether the intercept and slope of beta, that is risk measure, is significant. And we also noted that we can say this kind of equilibrium model is a fair game only when period by period changes of the constant and slope term of beta are purely random. Because if there is some systematic pattern in these and the deviations are not 0, then one could make money by predicting future changes. And therefore, for market to remain fair game with respect to this equilibrium model, the changes in the intercept term and the slope term should remain purely random. Now, the value of the slope and intercept term will be either RF or RZ depending upon the applicability of relevant standard CAPM or 0 beta version model of CAPM. Standard version of CAPM makes various assumptions that appear to be much distant and radically apart from real-life financial markets. However, the efficacy of CAPM does not lie in how good and accurate these assumptions are, but rather how effectively it explains the pricing behavior in real-life financial markets. In the discussion, we dealt with one assumption at a time, and we noted that doing away with each assumption, the resulting non-standard version of CAPM was mathematically involved yet tractable. However, simultaneously, multiple assumptions may not be feasible and difficult to arrive at such model specifications. First, we noted that short sale restrictions, the same market portfolio when short sales were fully available, remain efficient and optimum. In the absence of riskless lending and borrowing, we obtained a 0 beta version of CAPM, which involves holding two mutual funds, one market portfolio and other 0 beta portfolio that had a 0 correlation with the market portfolio. The 0 beta portfolio was not an efficient portfolio, and investors hold it along with the market portfolio only. When aggregating across the market, this portfolio has no investment. Next, we discuss the riskless lending and no riskless borrowing and differential riskless lending and borrowing cases. While we are still able to find security market line or SML that describes these non-standard forms of CAPM, the resulting model only describes portfolio of risky securities. The last case, that is differential riskless lending and borrowing case, is the one most closer to reality. Next, we discuss the case of non-marketable assets. Presence of non-marketable assets resulted in different price of risk and quantum of risk as compared to the standard version. We also discussed the case with heterogeneous expectations, and we found a simplifying assumption can be made about the sources of heterogeneity to obtain a simple and tractable model. The assumption stated that the only source of heterogeneity is about expectations about a set of economic activity that constitute these firms. We also discussed the non-price taking behavior of large institutional investors who collude and maximize their utility by taking a larger position in risky assets than that predicted by the standard version of CAPM. In addition, we also discussed multi-period, multi-beta and consumption version of CAPM. In closing, we discussed the tests of validity of standard and zero beta versions of CAPM. These tests involved first pass and second pass regressions. In the first pass time series regressions, individual security betas are estimated. In the second pass cross-sectional regressions, CAPM is tested through a series of hypothesis tests. These tests include first comparing intercept terms with RF or RZ, then examining the linear or non-linear relationship of beta with expected returns, and then examining the relationship of residual diversifiable risk with expected returns. Then examining whether market is fair game with respect to these CAPM models of equilibrium, that is period by period changes in coefficients are purely random.